I do want to think of it as basically a little bit different than these two main reports. Why? Because these two main reports are basically, if you think about how they are constructed as we do the data input. In other words, if I go to the plus button, let's go to the plus button here. Whenever we enter these forms are the data input forms that are used to generate the journal entries for all of the normal type of transactions that happen in essence on a day-to-day basis. We can think of them as recording according to the double entry accounting system, the debits and credits, or in accordance with at least two accounts impacted for the accounting equation, assets equal liabilities plus equity. And those then are used to create, we can think of as, in essence, a trial balance. And the trial balance is basically then used to create the profit and loss and balance sheet. So these reports are being generated directly from the data input. And that's why we can bounce over here and look at the impact directly every time we do a data input into the system. We enter a form. But the profit and loss is kind of a step removed. In other words, the statement of cash flows will be somewhat of a step removed, meaning if you think about the order of operations, we do the balance sheet, income statement, and then use those to create the statement of cash flows. Now, quick recap before we even go into the statement of cash flows. Why do we need it? Well, note that this income statement is the performance statement. It's showing the activity, what we have done over a time frame, measuring, and the analogy being like if we're driving a car and we want to see how far we're going to go in a day, we can reset the odometer and then see how far we're going to go. Income statement, we're seeing how much revenue and expenses we generate as we go through a month of activities, a quarter of activities, a year of activities, for example. However, the way we measure income and the way we measure expenses are when we incur the income and when we incur the expense, meaning when we actually did the work on an accrual basis is when we record the income, and when we actually incur the expense, when we consumed goods and services for the purpose of generating income, is when we record then the expenses. That's the accrual method. You might say, hey, look, I might not be on the accrual method. You might not be. You might have a more simplified system, such as a gig worker, for example, recording everything through the bank feeds, in which case you could still basically say you're on an accrual system, but you can also say you're on a cash system. The two systems, in essence, are the same under those circumstances because there's no timing difference between when you incurred the revenue and when you got paid, and when you incurred the expenses as to when you paid out the expenses. It's only when there is a timing difference, such as when you have to invoice the client, track accounts receivable, or enter a bill in the system and track accounts payable, that there will be a difference between an accrual basis and a cash-based type system. So if this is on an accrual-based system, the reason that's important is because the net income should be reporting performance that is comparable so that we can try to judge how well we did and hopefully improve. And that becomes a problem on a cash-based system for certain types of transactions. The most common example, or the one that's easiest to see, is like if we were to purchase a building for cash that cost, $100,000, and we just simply expensed it because we paid cash for it on a cash-based system, then that would mean, like, if I compare January to February, January would have over $100,000 loss in it because we bought the building. And February would look like it's not impacted at all by the building. But in actuality, of course, the building was bought as an asset. It should be on the books as an asset and then basically depreciated, the cost being allocated over the time frame that we use it, for example. That's the idea of the accrual system. And even if you're on a cash-based system, you typically, when buying a building, would do that automatically and or would be forced to do that by like the tax code, if nothing else, if you're in the United States. So, but we would still like to see a cash flow system on top of the accrual system. So how could we do that? Well, we can add another report. We get the best of both worlds. We see the income statement on a performance statement, on an accrual statement, and we then recreate, in essence, the income statement mainly, although we're going to have two other components to it as well, on a cash-based system. so that we get the best of both worlds. That's kind of the idea of it. All right, so how do we get to this to the report? Let's go to the first tab. Let's go down to the reports on the left-hand side, and within the business overview, we should have our statement of cash flows. Here it is, statement of cash flows. We will right-click on that and open a link in a new tab. I'm going to go to the tab to the right. I'm going to try to explain this one in more detail. This is going to be more of just kind of a theory idea rather than a data input thing for QuickBooks, because many people just simply don't understand the statement of cash flows that well. And it's obviously one of the three main reports, so it's useful to know about. There's also some different kind of constructions on where you can construct the report, so we should have some idea about that as well. Noting that for small businesses, you might not spend as much time on the statement of cash flows because you, for example, might just simply be trying to be in compliance, possibly if you're in the United States, with tax compliance, which means at the end of the year, what do you need? You need, at the minimum, a profit and loss report, because we have an income tax system. The profit and loss report is the report that's going to help you, mainly the report that helps you to generate your Schedule C if you're a sole proprietorship, or your other tax returns if you're a partnership or a corporation. Although in some cases, if you're larger, you might need the balance sheet as well. Now, we still want the balance sheet in QuickBooks because the balance sheet, it forces us to do the double entry accounting system. The double entry accounting system gives us much higher level of certainty that we have recorded things accurately. And so that means that our income statement is much more likely to be accurate if you enter the data into software that forces you to use the double entry accounting system, which will force you to create a balance sheet as well. Okay. So then, but so the statement of cash flows isn't typically something that we're going to use to do the tax return. So it's going to be something for reporting purposes that might be an added value giving us the cash flow, which of course is important because the cash flow is the lifeblood of the company. So now that we have our performance statement, income statement, not on a cash flow basis, then we might want to add the cash flow basis because again, the cash flow is the lifeblood of the company. All right, so here's going to be the statement of cash flows. Let's close it up and then open it up one by one. So I'm going to close up the three sections here and we'll just analyze it. So let's do this. This is only 1 month. Let's do it for the year here. 0101, let's say 24 to 12/31/24. Run it.